Mr. Roach, fantastic to have you back. Thank you for joining us. Last time when we spoke to you, it was all gloom and doom. It was markets were in a free fall zone. The medical crisis, in a sense, had snowballed into a big economic crisis. But now things are looking up, not on the medical front, on the economy front, and on the markets front. Are you pleasantly surprised the force with which financial markets, and especially US markets, have made a comeback?
Well, I've learned over my long career that stock markets are designed to humiliate most of the people most of the time, and this is certainly proven to be consistent with that old saying. Most of us, myself included, thought that the U.S. equity market in particular would retest the late March lows at some point over the subsequent few months. And of course, the markets, as you point out, have defied that conventional test, drawing support from extraordinary injections of liquidity by the U.S. central bank, and hopeful that the U.S. economy just experienced a sharp but temporary break during the lockoff, and now it's lockdown, and now it's back to a V-shaped, vigorous recovery, sort of analogous to that which occurs after a natural disaster, an earthquake, or hurricane, or something like that. I am suspicious of that optimistic prognosis, but I am certainly recognize that the markets are once again defying what seems to be logic and powering ahead in any sense.
Mr. Roach, I was too young to remember what happened in 1999-2000, but a lot of experts I've interacted with, they are saying that, look, there's a parallel between what we saw in 1999 and 2000, which is that markets remained here, economy was here, and they remained disconnected for a long period of time. Now, you've seen market cycles, you've seen many market cycles, analyzed them, you've understood the importance of market cycles. Do you think we've got all the makings of a market which was similar to what we saw exactly 20 years ago, where economy and market, they remained disconnected for a pretty large period of time?
If you look at a cyclically adjusted stock market relative to earnings, is that which is constructed by Yale professor and my colleague Robert Shiller, the market was more overvalued in early 2000 than it was today. Nevertheless, the markets did reach extraordinarily high levels in the period prior to the outbreak of the pandemic. So this is a correction from a high level at a time when the world economy was actually quite vulnerable.
Making a point on various forums that you expect the dollar trade to unwind. Whenever there has been crisis in the world in last 10-15 years, the world has migrated towards dollar. But your view recently is that you expect dollar to unwind and unwind very sharply. What has prompted you to make this big call?
Well, as I look at the U.S. relative to the rest of the world, while the equity markets have gone up sharply and bond yields have plunged to unprecedented low levels, in my view of the United States, something still has to give. And I look at the comparison of the U.S. relative to the rest of the world from the standpoint of domestic savings and our current account balance. And I see extraordinary disparities emerging in the United States. We started 2020 with an extremely low domestic savings rate of 1.4% of national income adjusted for depreciation. And that compares with a 7% average over the 45 years ending in 2005. And lacking in saving and wanting to grow, we import surplus savings from abroad and run massive current account and trade deficits to attract the capital. Our domestic savings rate is going to go from bad to worse. Our budget deficits are exploding right now. And so we will find our domestic saving sharply in record negative territory by the end of this year. And that will take our current account deficit to a new record greater than the 6.3% hit in 2005. And so currencies move to facilitate current account corrections, and I think that's what the US dollar is going to do. I would add one other thing to that it's not just the current account and the domestic saving that's driving the dollar lower, but the US has abdicated its global leadership position, leading the way in pushing for deglobalization, decoupling, trade protectionism, and it's failed miserably in containing the coronavirus and is in the midst of a major racial upheaval. So the dollar has always benefited from what we have called American exceptionalism, and as the world's dominant reserve currency has been given the benefit of the doubt for a long, long time. I think that benefit is also being drawn into serious question, and in the conjunction with the current account saving issue that I've noted, the dollar is probably going to correct by as much as 35% on a broad trade-weighted basis over the course of this year and next year. And that would be a sharp correction, but not an unprecedented correction. We've had 3 such corrections comparable to that since the 1970s.
Mr. Roach, I'm going to ask you perhaps something you've been asked before. Last time when the dollar declined, it coincided with a sharp rally in commodities and emerging markets. Are we in for a reversal of the previous cycle, or this time it's really going to be different?
Well, everybody always asks me, they say, when the dollar goes down, what's it going to go down against? What other currencies in the world are likely to rise in this environment? And I think the major beneficiary will be the euro. The euro is the most unloved major currency in the world. Everyone, myself included, has been a euro skeptic waiting for the European Monetary Union to fall apart, and it hasn't done that. And the recent agreement by Angela Merkel and Emmanuel Macron to establish a 750 billion euro next generation EU fund, together with the likelihood of a pan-European sovereign bond issue emerging as a new riskless asset in the world, that points to considerable upside for the euro. I also think the Chinese renminbi, which has moved up about 50% since late 2004, has further upside, and it's been showing that in recent days as well. I would also look for dollar weakness to be accompanied by strength in gold and possibly even the cryptocurrencies like Bitcoin. As for other emerging markets, I think in a declining dollar environment, they might benefit a little bit at the margin, but by not as much as the alternatives I just mentioned.
Mr. Roach, is the world prepared for a second wave of coronavirus? Because on the medical front, the evidence clearly is that things have not plateaued out or things have not peaked out like they say. So if the virus is not peaking, what are the chances that it may have another second wave of virus could have a fresh round of selling for financial markets or chaos for the financial markets?
No, the world markets are not pricing a major setback in economic activity. It's, even though the virus is once again creating huge problems in the United States. And today, just looking at the numbers that were just published, we have a record 63,000 plus in the way of new cases. There are rumors of lockdowns, but the markets don't seem to be taking those rumors very seriously at all. And yet we know full well from the lockdown of from mid-March through the end of April, that will lead to a serious problem for output, jobs, income, and of course the budget deficit, which is the root of my concerns over the domestic saving and the current account dynamic that I described.
So, Mr. Roach,
earlier.
given that we are nearing the next US presidential election cycle, and you got the Democrats and the Republicans, as always, clearly indicating separate things, what they want from the economy, what their view on financial markets and financial regulation could be. What is the importance of this year's presidential election? I mean, now it's evident it's going to be Trump versus Biden or Biden versus Trump.
Look, I think the U.S. Presidential election is of enormous consequences to the future of the United States and to the future of America's leadership role in the world, and then by inference to the world order as it stands right now. We are on a treacherous path right now with President Trump pushing hard for deglobalization, decoupling, trade protectionism, ignoring federal policies to control the coronavirus, and also being insensitive to the outbreak of America's racial upheaval. These are not good trends for the United States to stay on. If we remain on the path as indicated by President Trump's actions in the first 3.5 years of its presidency, then America will face a very treacherous future, and the world will suffer greatly as a result. Vice President Biden, if he is elected, and the polls are pointing in that direction, will have a very challenging set of problems to inherit, and we can be hopeful that there will be a significant shift in all of the issues that I just mentioned, but it will not be easy. He will inherit a very difficult situation in the economy and a difficult situation in dealing with America's public health and racial issues. And that will require a very different approach, and I hope he's up to that challenge if he were to be elected.
Mr. Roach, last 10 years, the two large consumption-driven economies were India and China. China is slowing down below its, the GDP growth is certainly below its 10-year average, and that's the story for India. We've plunged in historical low. What impact do you think this could have, A, on global growth? And for this century, or for this decade, where do you think the next growth engine is going to be coming from?
Well, I think the post-COVID recovery is going to be a weak one, just like the global recovery was very weak in the aftermath of the global financial crisis. I do believe that while it's been relatively straightforward to normalize the supply side, in particular by raising production and bringing workers back to work, it's much tougher to normalize the demand side, where consumers remain fearful of infection and participating, therefore, in face-to-face activities like eating in restaurants, travel, leisure, and shopping. And I think the shadow of that behavioral shock will be an enduring feature of the post-COVID recovery and keeping the global growth rate more subdued than we would like to think and hope in the aftermath of the severe shock that we saw to the world in the first quarter and the second quarter of this year.
Right. Mr. Roach, I'm just going to take a very small detour right now and get into the market meanwhile. And if I really check on the market action right now, the market clearly seems to be indicating that there is a little bit of resistance which has come at the higher level. Reliance, Bajaj Finance, ICICI Bank, all of them are trading with a negative bias. But back to what we were discussing, Mr. Roach. Given that there is a very strong rhetoric against going global in India, the government has started a campaign called Atmanirbhar campaign, which is Make India Self-Reliant. In America, it is Go America First. What do you think will be the impact of this on global growth if deglobalization gets stalled? And what will happen to China? Because China is the factory of the world, which in a sense was supplying to the world. If the Chinese products are not going to be accepted by the consumers, then I wonder how will this backfire for China?
Well, by some measures, especially the one that is used by the IMF to add up the global GDP, China is the biggest economy in the world by purchasing power parity. And since the world financial crisis, the growth in China has accounted for between 35 and 40% of the cumulative growth in the world. And so if the world is going to put pressure on China and the Chinese economy were to slow precipitously as a result, that in and of itself would lead to a major shortfall in global economic activity because there's no country that's going to fill the void. What China has done, I think, is focus increasingly on driving its economy through domestic demand, especially personal consumption expenditures of its growing and rising middle class. This will insulate China somewhat, but not completely, from the pressures that are being brought to bear on its export business through countries like the United States and America's allies that are sympathetic to the trade war that President Trump has launched against China. While China's dependence on exports, its dependence on global demand has moved down sharply over the past decade, exports still account for around 17% of Chinese GDP. And so it cannot take these external pressures lightly. And that raises problems for China and problems for the world economy.
Mr. Roach, historically, the way economies and markets they follow a cycle is that every cycle follows the same pattern. There is a zero phase, there is a peak phase, there is a participation phase, there is a bubble phase, then comes a drop in earnings, and then comes bankruptcy, and then the fresh cycle starts again. Do you think this time around the cycle could be different purely because interest rates are zero?
Well, look, central banks have figured out how to create money out of thin air. And there was an article in one of our leading foreign affairs journals that was titled Magic Money. I don't believe in magic money. I think that as long as interest rates stay low and they remain extremely low, near zero, at the short end of the yield curve, there are no meaningful consequences in terms of debt service for countries that are taking on enormous increments of new debt. And so for the US, which is running budget deficits this year of close to 17% of GDP, on average about 14% of GDP over the next couple of years, there's no real penalty for doing that if the debt service is low because of extraordinary accommodative monetary policy by the Federal Reserve. But if the day comes where the Federal Reserve has to normalize interest rates or even begin that process because of concerns over inflation, which I don't rule out in a weak dollar environment, then the debt service pressures will be very constrictive in terms of their impact on debt-intensive economies like the United States. So, as we learned in earlier cycles, frothy cycles, you stay on the dance floor as long as the music keeps playing, but when the music stops, you're in serious trouble, and that's a risk certainly for the United States with its buildup of debt, massive buildup in debt that is now underway.
But ultimately it boils down to one simple question, Mr. Roach, that one day Fed will have to normalize rates. How long do you think they will print money? Because this kind of a zero interest rate environment where you're stimulating the economy by buying back bonds and corporate bonds, it could be ETFs one day, it's not going to continue.
As long as inflation is below target, the Federal Reserve will get away with printing excess money. But will inflation remain dead forever? I started out my career in the 1970s when we certainly believed that there was no inflation problem. And then we emerged with a very, very serious inflation problem that required extraordinary tightening by the U.S. Central Bank under Paul Volcker's leadership. I don't see inflation coming back the way it did in the late 70s and the early 80s. But with the pressures for bringing supply chains back home, moving from offshoring to reshoring, with a sharp and precipitous decline in the dollar that I am looking for, there is a possibility that inflation will not be as well behaved in the years ahead as the magic money solution requires. And if that's the case, then a modest buildup of inflation will prove to be very problematic for debt-intensive economies like the United States. This is what happened to us right after World War II. After World War II, our public sector debt to GDP ratio hit what we thought would be an unprecedented high of about 104% of GDP. Over the next several years, we're going to break that record. And as we did in the aftermath of World War II, we reflated our way out by boosting our real growth rate a little bit, but also allowing for a significant increase of U.S. inflation. I think that reflationary outcome is very much a risk today.
So closing comments, Mr. Roach, how does one go about investing capital in this kind of a market? Because if you're investing capital, you're essentially aligning your capital to future and how your capital should benefit from future, from how the future will unfold. How can one invest or position capital when the future is so uncertain?
These are treacherous markets. We saw the sharpest decline in global equity markets in late March that has ever occurred on record. We've seen a significant rebound since then. I think investors know how to handle this better than economists, but this is not a time, I think, to throw aside any concerns over risk. There's likely to be considerable volatility in the months ahead, and positioning is going to be very challenging in this environment, especially if there are further setbacks on dealing with the coronavirus and what this means for the risk of a potential new lockdown in economic activity or some moderation of economic activity. Our markets are priced for perfection right now, that there are no accidents on the virus or economic activity front in the weeks and months ahead. I'm skeptical of that, but I've been wrong in recent months, and yet I still continue to worry about those possibilities.
All right, Mr. Roach, really appreciate your time. Stay safe, and thank you for joining us.